Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be the Thursday, the 12th of September 2024. So before we start our Daily Dose of Market Insights, as usual, let's have a quick look at the disclaimer. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, all good. So yes, so as usual, let's start off with what has taken shape yesterday in terms of the intraday performance of the major cross asset classes and what are the relevant key news flow and respective economic data releases that causes this movement. All right, so yesterday we know that we do have this all important US CPI data release. So I would say that it causes a bit of volatility, increased intraday volatility in the market, especially on the stock indices. So what do I mean by this? So if you look at the major US stock indices over here, what we could see that initially after the release, upon the release of the US CPI data, that was at 8:30 p.m. Singapore time, 1 hour before the official start of the US cash stock market session. Then after that, once the cash stock market session opened, across the board, we do see a minor sell-off, intraday sell-off in the major US stock indices. But what interestingly is that this sell-off actually managed to find support at our intraday short-term pivotal support level. For those who know what I mean, is those are the support level that I covered on the intraday technical outlook, both on the Nasdaq 100 and the Nasdaq 100 and the Dow Jones Industrial Average US Wall Street 30, both of their respective key support level held as expected and shape that V-shaped intraday recovery back towards our short-term intraday resistances. So what we could see over here is that V-shaped recovery across the board. This was the Dow Jones, on the Nasdaq 100 as well, pretty much strong on the intraday recovery after market digests the US CPI data. Later I'll talk more about that, why there was a bit of panic sell-off at the start of the US session in the first hour or first and half, 1.5 hour or so. And we do see very similar movement on the Nasdaq 100 as well. So in terms of the intraday, we call it performance, the Nasdaq 100 was the outperformer, led by the mega cap technology stocks because they are heavily weighted inside the Nasdaq 100, up 2%. 2.17% to be precise, then followed by the S&P 500 up 1.07%. Then thereafter, the one that is lagging behind will be the Dow Jones and the Russell 2000. Both of them only managed to gain by 0.3% due to some form of, we call it weakness on the financial stocks in the Dow Jones Industrial Average, and the Russell 2000 is primarily focusing on those small cap stocks over here, and also pertaining also more or less related to Donald Trump performance in yesterday's we call it his first debate with Harris. And if you look at those who watch the debate over here, is that Harris tends to be much more on the offensive compared to Trump, which is being held back by Harris so-called Trump's accusing Trump's of lies. All right, so we know that Trump's is more pro-business due to his tax policy. He's kind of, kind of a rather much more extensive corporate tax cuts, so that could actually benefit most of the cyclical stocks, all right, especially the small cap stocks over here. So at this point in time, what we could see over here is that this is due to more of a intraday, we call it event that takes shape yesterday due to this debate between Trump and Harris, and we shall see how this play out as the days goes by. All right, so one thing I'd like to share is that before we go to another event or another so-called news flow, is this heat map on the S&P 500. So like I mentioned earlier on, why the Nasdaq 100 actually outperformed, because of the very clear outperformance of the mega cap technology stocks yesterday. we could see across the board. Then if you go down by the impact of the groups over here, so in terms of the groups will be breaking down into the 11 sector. So on the that's is the intraday performance. So you could see that those sector that the mega cap stocks that has a huge weightage in it all doing outperformance. Technology, this is where Nvidia are there. Consumer cyclical, this is where Amazon is there as well. Then communication service, this is where Google Alphabet is being residing in this particular sector. And the worst hit was the cyclical. Financial got hit as well, down, not that bad, but still, I mean, underperformed by negative 0.23%. Followed by the defensive sector, which is the consumer staples, down negative 0.65% over here. So net overall, right, let us now share with you all the economic data. Okay, so I want to here's why there was a panic. Because market initially look at this core inflation rate month on month. So if you look at the month on month figure, yes, it actually increases slightly upwards 0.3%. But you know, month on month is rather volatile, I would say. So you look at it over here is that it actually went up slightly by 1 basis point above expectation. Market is expecting at 0.2%, but over here it came out slightly higher, 0.3%, also above July figure of 0.2%. So if you look at the core inflation rate over here, month-on-month basis, it's a very volatile trend. All right, it's a kind of very volatile trend. So you go to the 5-year trend, right? This is just zigzaggy over here. So if you were to break it down by the year-on-year one, it still remains the same at 3.2% within market expectation. If you look at you move away from that month-on-month season, we call it cyclical or seasonal factor that could be appearing in every month, and you put it on a year-on-year basis to remove all this seasonality effect. If you look at the trend on the core inflation, that means stripping off energy and food component, it's still showing a clear path of a deceleration in terms of inflationary trend in the US. So if you look at it from a 5-year basis, very clearly from a high of 6.6 in September 2022, so close to 2 years, it has been now on the path of deceleration. Okay, so that actually causes also the market to actually digest initially that fear of that month-on-month slightly pump up on the core inflation this month-on-month, where it went up to 0.3% versus 0.2%. Then after market digests the longer term inflationary trend condition, then once the dust settle down, things go back to normal again in terms of very clearly the US inflationary trend is still on a path of deceleration rather than acceleration, and that also more or less cemented the interest rate cut cycle that is very highly likely to kickstart in next week Fed FOMC meeting. It's only that for next week, initially there was some higher odds in the market, not higher odds, there was some pockets in the short-term interest rate futures market that is pricing in a jumbo cut of 50 basis point to come in next week or next Wednesday or Thursday early Singapore time. But after yesterday's CPI data release, that jumbo cut of 50 basis point, that odds came down a fair bit. And how do we know that? By looking at the CME Fed Watch 2. So if you look at the CME Fed Watch 2 over here, this is the target. This is the market expectation for the upcoming next Wednesday or Thursday. If you look at Singapore time, 18th of September, FOMC meeting. The current Fed funds rate is at 5.25% and 5.5%. Right now, there's an increase of very high chance only the Fed will go slow on the first meeting on the first interest rate cut of 25 basis point. Okay, after pausing for close to about more than a year, to bring it down to 5% to 5.25%. Only a small chance based on the short-term interest rate futures pricing, that means the 30-day Fed funds futures pricing as compiled by this CME Fed Watch 2. Only 50% chance right now is indicative or it has been priced for a jumbo cut of 50 basis point to bring the Fed funds rate down to 4.75%/5%. And if you look at the odds last week, so last week we know that we do have some key data out as well, which is the ISM manufacturing, ISM services, and non-farm payroll data. So initially, the non-farm payroll data was rather lackluster because the previous month was revised downwards, and also do not forget the latest month of August came below expectation. So we do have a kind of a not really that high odds, but a significant bump up to 44% chance, below 50% chance, but I would say it's still rather on the high side. So initially there was a 44% chance pricing of a jumbo cut, and after yesterday's CPI data release, it reduced down to 15%. Then what's interesting over here is that if you look across down the calendar, that means looking at the expected pricing based on the CME Fed Watch 2, the Dow doesn't actually change. I mean, the needle doesn't really change. So market is expecting before 2024 ends, there got to be at least 1% cut from the FOMC by the FOMC committee, which is i.e. the Fed. But how do we know that? By looking at this aggregated probability. All right. So what they do over here, based on the CME Fed short-term interest rate futures contract, but taking into account of different contract dates, we are able to price in the market expectation on future expected trajectory of the US Federal Reserve monetary policy stances. All right. So what you do over here is that this one, the first one on the 18th of September, like I shared earlier on, 85% chance it will be a 25 basis point cut to bring it down to 5% to 25.25%. But in the 7th of November meeting, which is very interestingly 2 days after the 5th of November US presidential election conclusion, all right, market is expecting rather high at 58% chance of a 50 basis point cut. Because let's say if we bring it down to 5%, the next step over here is in 25 basis point cut will be 4.75%, but market is only looking at only a 41% chance or 42% chance, a higher chance of 58 basis point for a 50 basis point cut, potentially in the 7th of November FOMC meeting. Then thereafter, before the year ends on the 18th of September FOMC meeting, it will be a high chance of 83% of a 25 basis point cut to bring down to 4.25%, 4.5%. So net overall, the market dynamics still remains the same. That means the Fed itself is going to be kicking off its interest rate cut cycle next week, and the pricing of the jumbo cuts, there is still one high chance to come in the 7th of November FOMC meeting. So net overall, what we see over here is that despite the earlier so-called month-on-month US CPI bump up of 1 basis point, the FX, the euro, the so-called the strength of the dollar was not really that prevalent in the FX market. How do we know that? By looking at the chart of the dollar index. Okay, so you look at the dollar index chart over here. Okay, it's still kind of trading sideways. Okay, let me expand my screen. Yeah, over you can see. Yeah, so it has been trading in the very sideways range since, okay, this was, yeah, daily, correct. Yeah, since Tuesday, since the start of this week, Tuesday, sideways range. And if you look at the candlestick of the day, this is a daily chart. The daily candlestick of this US dollar index also showing a very small little body at the top. That means, i.e., it represents hesitation by the bullish side of the camp to push prices higher. So it's more like a rangy market in the last 3 days or so by looking at the performance of this dollar index. And if we were to actually break it down accordingly by using this 5-day rolling performance of this US dollar against the major currency, so this will be as of now as we are speaking, okay, 12 September. Okay, let me put it in. Okay, just let me refresh for a while, make sure there is a 5-day rolling performance, so it's very short term. So I could see over here it's still in a sideways rangy configuration in a very short term basis. So if you stretch it up for a 1-month rolling performance, data, it seems to be that the dollar is still showing a path of weakness, trending initially downwards. All right, so this is from the 1-month rolling basis across all the currency that we have monitored. All right, so basically using dollar as the base currency, dollar against Kiwi, dollar against Swiss franc, dollar against sterling. All right. So now one more particular news flow I share with you all today is up from a particular BOJ official. Okay, so BOJ officer Tamura, he actually mentioned, did make a public speech earlier at around 9 a.m. Singapore time. So he reiterated yesterday's his colleague also on a firming path of potential future interest rate hike going forward in BOJ. So among the camp in the BOJ over here, together with the leader, BOJ Governor Yuda, they are still in favor of hiking rates, despite the fact that that previous hike that took shape about in the month of August, about not too long ago, 4 to 5 weeks ago, causes a bit of negative feedback loop into the global markets based on from the fixed income, from the stock market, and as well the FX market. They are still looking for a path of interest rate normalization, despite we know that Japan has been in decades long of very, very low interest rate and ultra easy monetary policy. The current economic condition in Japan doesn't warrant that, and majority of the Bank of Japan officials are leaning towards a path of gradual interest rate increase or interest rate hike. And at this point in time, but he did have a little mention over here saying that they will keep a close eyes out on financial market move and their impact of their economy. All right, and prices must rise rates at the appropriate timing in several stages. That means what it means that there's a caveat. Yes, they are looking to rise rates, but they're also looking at to monitor the current the condition of the global markets before deciding whether to rise rate in any particular meeting for BOJ. That means they are taking things one step at a time. Preference is to actually increase interest rate in Japan. So that actually saw the dollar yen still holding off the 143 figure level despite yesterday's bounce up from the 142.25 level during the US session yesterday. So later I'll talk more about that when we cover the intraday short-term technical outlook on the FX market. All right, so that actually sums up this today's so-called events that took shape yesterday and early this morning and their impact on the various broad-based cross-asset classes. Okay, so today there will be no inter-market dynamics and fundamental, nothing much interesting to share with you guys. So let us now straight away jump into the intraday technical outlook on the various major cross-asset classes that we tend to cover on a regular basis, starting with the FX market. Okay, so before that, let me expand my screen so that you guys could have a better visualization on the chart. Okay, so let me start with the euro dollar. Okay, so the euro dollar, it came down but managed to hold right exactly at our 110 short-term pivotal support that we highlighted yesterday. So still no change using 110 short-term pivotal support. Still maintain that potential bullish buyers looking for a start of a minor recovery kicking in into the euro dollar, supported by this continuous rising RSI that continue to shape higher low very near the oversold region. So but I do have a shorter near-term resistance level to watch for today on an intraday basis will be at 110.50. Okay, let me put it in writing. Okay, 110.50. So a clearance above 110.50 will give a much more increased odds for it to actually kind of retest the 20-day moving average, now acting as the next intermediate or next near-term resistance at 1.1089 or 1.1089. Above it sees last Friday non-farm payroll spike up level or swing high level at 111.40. All right, 111.40. And like to remind you all, today will be another key data that could be pertaining to the euro dollar, which is ECB monetary policy decision that will be out later today. I'll touch on what time would it be when I cover the segment of key data to watch out for today. Only an hourly close below 110 figure level will invalidate our intraday bullish bias, to see the continuation of this minor extension of this minor corrective decline to expose 1.0950 and below it potentially sees 1.088, which confluence with the 200-day moving average, I think as a similar, very close to the similar graphical support level as well. Okay, so that's for the euro dollar. Now, moving on will be the sterling dollar. So the sterling dollar also managed to sell off, but managed to bounce back exactly as our short-term pivotal support zone that we highlighted yesterday at this level zone of 130.40 slash 130.10. So given that this support level still remains intact and it managed to shape a bounce off it, we will still maintain our short-term intraday bullish bias on the sterling dollar. First resistance level to watch will be a zone right now, 131.10. Let me put it in writing. 1.3110, 1.3140. Okay, so only a break up above 1.3140 potentially could see a revisit on last Friday non-farm payroll swing high level at 1.3220 over here. Okay, so but however, if it starts to break down below 1.3010, then it will invalidate today's intraday bullish bias to expose the next near-term support level at 1.2940, which confluence very closely to this rising 50-day moving average. So net overall, right, the sterling dollar is still trading in a medium-term uptrend. Why? Because price action still remains positive above the 50-day moving average, and as well as the 20-day moving average is still holding above the 50-day moving average. Okay, so now let us now take a look at the Asia Pacific currencies, starting with the Aussie dollar. So the Aussie dollar yesterday managed to do a bit of a push down, but managed to pierce back up above the 66.40 short-term pivotal support level over here. So still no change, 66.40 short-term pivotal support level, but it got to clear above 66.90 to give a bit more credence for this minor recovery scenario to extend, or the mean reversion rebound scenario to extend to actually look out for the next resistance to come in at this 67.10 slash 67.20. Okay, so it's a range over here. Let me put it. Okay, was because of the 20-day moving average, which is at 67.20. Okay, let me put it in writing, 67.20. All right, so only a clearance above this 20-day moving average at 67.20, then potentially we may see a bit of further extension of this push up to seek up this last Friday non-farm payroll swing high area at 67.60 slash 67.775, and this level over here also confluence very closely to the key Fibo retracement level of the golden ratio, right, of 61.8%, pretty much close. Only a price breakdown below 66.40 will invalidate today's intraday bullish bias to see another round of a choppy decline scenario or minor choppy corrective decline scenario to expose the next near-term support level at 66.10 slash 66 figure level, and even potentially 65.70 next, which is the minor swing low of 9th of August and 15th of August. So that's for the Aussie dollar. Now, dollar yen. So dollar yen, earlier on, I did mention that we see a bounce. Okay, where was it? Yeah. Okay, we see a bounce very close to the support level that we highlighted yesterday at 140.25. It printed a low of 141.71. Okay, 147 before it bounced, but managed to actually stop at the first resistance that we highlighted yesterday at 142.70. So what I'm going to do over here is that I will put a slightly tightened key short-term pivotal resistance for today at from 144.30 to 143.70, which is this 3 minor swing high area of 6th of September, 9th of September, and as well as 10th of September, that is acting as a very clear near-term intermediate resistance for the boost right now at 143.70. And what's interesting over here is that uh, at this juncture, price action is getting very hesitant. So what I do over here is that it's being supported by this rising higher low, and this could be potential a bearish flag formation. Okay, a bearish flag formation. Okay, so in this kind of bearish flag formation, it's a continuation formation. So with the lower boundary at 142 figure level. So what I could see over here is that if price starts to break down below 142 figure level later, then that could increase the odds of this impulsive downward sequence to continue within its short and medium term downtrend phase. Why? Because the price action still remains below the 20 and the 50-day moving average. And as well as we look at the RSI also managed to form a resistance, a parallel resistance at around the 60 level over here. Okay, swing high, swing high, swing high, and rejected at the moment in time. But you got to break down below 142 figure level, which is the lower limit of this bearish flag, to increase the odds of the resumption or the continuation of this impulsive downward sequence. So first support level to watch will be at 140.25, no change. Then thereafter, a breakdown below it exposes 139 figures slash 138.75, which is a Fibo extension level of 1.382, taken from the high over here of taken from the high of 16th of August, and as well as graphically is this support level over here. Okay, if we go back in time, okay, this minor swing low of 28th of July 2023. Then, but however, if price starts to break up above 143.70, then we got to respect that the best is no longer in control anymore, where the price action may translate into a mean reversion rebound scenario again on the dollar yen to retest the 20-day moving average area at this 145.40 slash 145.90 area zone. Okay, so that's for the dollar yen short-term intraday technical outlook for today. So now with that, let me share with you all one particular FX pair to keep a lookout for, also pertaining to the FX market, will be this Euro Sterling. So those who recall Euro Sterling, last week we also featured this as one of our FX crosses, but more looking for a bullish bias for the bounce. So the bounce indeed takes shape and almost hit our resistance level or the resistance zone around the 84 handle, 85 handle level, which is very close to the 20-day and the 50-day moving average as well. And what you could see over here is that price action hit that level and shape a bearish reaction of it. Okay, so what we are looking at right now is that potentially given the rejection of the 20-day moving average and the 50-day moving average, and if you look at from a daily price action perspective, over here it also form a long tail candle as well upon hitting the 20 and 50-day moving average. So back to the hourly chart, so we'll be using this 84.70 as my short-term pivotal resistance on this Euro Sterling cross pair. Flip to a short-term intraday bearish bias. First support level to watch will be 84.20. Breakdown below it potentially sees the next support level coming in at 83.97, 83.87, which is close to the previous swing low of 30th of August, 24th of July, and as well as 17th of July this year. Only an hourly close back above 84.70 will see the extension of this minor corrective rebound scenario in its extension phase to actually see the next near-term resistance coming in at 85.10 next. Okay, so that's a particular FX cross pair that we can take a look out for on the intraday basis for today. That's Euro Sterling. So now moving on will be the major stock indices starting from the Asia market. So Hong Kong 33. So Hong Kong 33 today's the price action pierced up back above the 200-day moving average again. All right. So what we could see is that pretty much of a reduction in the bearish momentum that was presented yesterday. So given such mixed element on the intraday basis, I got no conviction right now in terms of the directional bias. So flipping to a neutrality stance on the Hang Seng Index, i.e. the Hong Kong 33, between 17,330 and 16,970. Only a breakout above 17,330 may see the extension of this bounce to expose the next near-term resistance level at 17,500 slash 17,595. This congestion area here, or 5th of September and 4th of September. And if we do the Fibo retracement, taking into account of the ongoing slide from 30th of August all the way down to yesterday's intraday low, that confluence with the 50% retracement, Fibonacci retracement. Okay, so that's for the Hong Kong 33. So now turning our attention to the Nikkei 225. So the Nikkei 225, yesterday we have a neutrality stance. So it broke above the neutrality stance, almost hitting the resistance level at the 37,170. And what's interesting over here is that since it came very close to this resistance level at 37,170, the amount of candlestick in the what do you call it, the shape of the candlestick that is being formed in the last 3 hours, because it's an hourly chart of the Japan 225, i.e. the Nikkei 225, it starts to form this kind of very bearish reversal candlestick, shooting star, hanging man, then followed by this black candle. All right, this black body candle. So it seems to us that this push up earlier this morning Asia session is not really that positive, but rather shaping 3 candles of bearish reversal candlestick, indicating that perhaps there could be some form of a slight back by the in terms of price action as being depicted by these 3 bearish reversal candlestick. So with that, we will actually now flip to a bearish bias on the Japan 225 or the Nikkei 225 using this 37,170 as my short-term pivotal resistance level. Okay, very clearly this is a congestion area here. Previously resisted, come break, and thereafter shape that last leg of slide on last Friday. Okay, so using 31,170 short-term pivotal resistance, flip to a short-term intraday bearish bias. First support level to watch for today will be 36,195. Breakdown below it, revisit 35,115, which is close to yesterday's swing low that managed to survive. Also the swing low of last Friday as well, very close. However, if price starts to break out above 37,170 with hourly close above it, then this mean reversion rebound extend to expose the next near-term resistance level at 37,570, 37,880, which confluence with the 200-day and the 50-day moving average, acting as a similar resistance within these 2 resistance level as well at 37,570, 37,880. Okay, so that's for the Japan 225. Now, what's up next on the German 30 or the German DAX? So the German DAX over here is that yesterday it traded sideways, but managed to hold below this 20-day moving average. So I think as of resistance at around 18,540. So I'll be using this very clear congestion area over here, 18,660. So if you look at it, so this is the minor swing high area of 4th of September and 5th of September congestion before leading to that previous that what I call prior decline in the German 30. And if you do the Fibo retracement, taking off from the start of this slide from 3rd of September all the way down to yesterday's intraday low, it corresponds to the golden ratio as well. Okay, so using 18,660 as my short-term pivotal support resistance level, pardon me, not support level, still maintain that intraday bearish bias on the German 30. So we do have a first support level to watch, will be yesterday's low, this level here. Okay, that was supported during the US session at 18,275. A breakdown below 18,205 potentially revisit last Friday's swing low level, which is very close to this former congestion area here as well in 22nd of July and 25th of July, acting as a next near-term support level at 18,160. But however, if we start to see a break up above 18,660, then forget about this bearish bias anymore. That means, i.e., the price action will now to see a much more conclusive recovery in first step to expose the next near-term resistance level at 18,820. All right, so that's for the German 30. So now, turning our attention to the major US stock indices, starting with the Dow Jones Industrial Average or the US Wall Street 30. So yesterday, we do have a short-term pivotal support at 40,140. So this support has been in place since this week. On Monday, price action hit the pivotal support and shaped that V-shaped recovery here. So later I'll share with you all is because its element now is rather mixed as well. I will actually have a neutrality stance for today on the US Wall Street 30 because of a potential slide in the Nasdaq 100. Later I'll share it on the short-term intraday technical on the Nasdaq 100, all right, because it really hit that key short-term resistance level. So neutral between the US, between this 41,040 slash 41,200, and the lower limit of this neutrality range will be at the 50-day moving average 40,400, which is the lower limit as well of this minor ascending channel that I drew from the low of 6th of August. So for US Wall Street 30, we are flipping to a neutrality stance right now. Why? Because of a potential minor bearish reversal that could be formed on the Nasdaq 100. So neutral between 41,040 slash 200 and neutral between 40,400 for today on the US Wall Street 30. Okay, so now moving our attention will be the Nasdaq 100. So I could see over here is that the Nasdaq 100 managed to bounce within our expectation from the short-term pivotal support that we highlighted yesterday, all right, at around the 18,450 level, bounce up, hit the resistance level, now coming very close to a bunch of elements that could see that potential reversal taking shape, which is i.e. number one, the 20-day and the 50-day moving average coming to act as a resistance. And if we do that entire Fibo retracement of that sell off from 22nd of August high all the way down to last Friday swing low, the golden ratio of 61.8%. And if we do the Fibo extension of this ongoing decline, ongoing bounce, the bounce that take shape on since last Friday, it also confluence with the 1.618%, exactly at the Fibo ratio of 61.8%. 20-day, 50-day moving average acting as a resistance level. So this could be a potential inflection level for that minor bearish reversal scenario to play out on the Nasdaq 100. And coupled with that, the RSI has really hit the oversold region. So we're taking things one step at a time first. So using 19,340 as my short-term pivotal resistance level, first near-term support level to watch will be at 18,900. Okay, only this 18,900 breaks down, then potentially it may expose the next near-term support level at 18,485 on an intraday basis. All right, so these are the two key support level to watch for today. But however, if price starts to pierce up above 19,340, then we know that this is a very important inflection level. Then this bounce may extend towards the next near-term resistance at 19,630 next. Right, so that's the short-term intraday technical bias or outlook for the Nasdaq 100, and as well as for the rest of the major stock indices that we covered earlier on. Okay, now shifting our attention now to the commodities market, starting with Gold XAU/USD. So Gold XAU/USD yesterday managed to actually do another push up again, right at the 2,532 level, very close to it, come break and then do the sell off. The sell off managed to help exactly at the 20-day moving average. All right. So the first support level, we could be using this level here, 2,500, which is the 20-day moving average. But since it's still inside this range for the past 4 weeks or so, 2,532 and 2,473, I do not want to use the 2,500 as a short-term pivotal support level. So still using 2,473 as my short-term pivotal support level, maintain that intraday bullish bias on gold, break out above 2,532, exposes the next near-term resistance zone at 2,588/2,595 in the first step. Only a breakdown below 2,473, then that should potentially give way to the start of a minor corrective decline to retest the next near-term support level at 2,435/2,415 level. Right, so that's for Gold XAU/USD. Now, lastly will be the WTI crude oil price, the West Texas oil. So West Texas oil yesterday managed to also a kind of very wild whipsaw formation. Initially sell off at the start of the US session, retested the low on Tuesday before bouncing back up again, and it still remains below the 68.20 short-term pivotal resistance that we have for yesterday. So still no change, still using that 68.20 as my short-term pivotal resistance. Maintain that short-term intraday bearish bias. First support level to watch will be 65.10 on the or for today. Or what we can do is that to be more conservative, we could use this low here. Okay, this minus swing low here, 65.94. Below it, 65.10. All right, so it's like a zone for today on a short-term intraday basis. However, if price reintegrate back above 68.20, that means we are already close above this short-term pivotal resistance, then today's intraday bearish bias will be invalidated to see the start of another mean reversion rebound scenario taking shape to do the retracement back towards the downward sloping 20-day moving average. In first step, the next two resistance level to watch on the intraday basis upon the breaking of the 68.20 will be at 69.40, followed by 71.15. Okay, let me put it in writing over here, 69.40. Okay, followed by 71.15 level. Okay, these are the two levels to watch out for. So that's actually sum up the intraday technical outlook on West Texas oil. Still maintain that short-term intraday bearish bias as long as 68.20 short-term pivotal resistance holds, and also sum up the short-term intraday technical outlook across the board. Okay, so before we go, let's have a look at the calendar. So I did mention that today's key event will be ECB. So ECB will be out later at 8:15 p.m. Singapore time. So what market is expecting is that the main refinancing rate, there will be a 25 basis point cut. So this will be the second cut since the first cut earlier in the start of the summer this year to 4%. Okay, so now the next key thing is that because that has already been priced into the market, so market participants will be looking at two things. One will be the ECB dot plot. So what they don't call it a dot plot, they actually call it the economic data update. So they will release their economic data update that has projection on inflationary trend in Eurozone, and as well as economic growth projection for Eurozone as well in for this year and next year and the year thereafter. Okay, so something to take a look at for. And most important, market participant will be looking at the conference between ECB Governor Lagarde and the reporters. So reporters will be start quizzing her what ECB stance will be going forward the rest of the year and as well as early next year over here. So something to take a note of that could actually impact the FX market. So other than that, during the US session, we do have some data to take note as well. Uh, yeah, over here, PPI. Yeah, PPI. So PPI data, we call it factory gate prices data, not so important as comparatively to the CPI data. So that will be out at 8:30 p.m. Singapore time. All right, then we have another job data. We call it the continuous jobless claim data, but I'm not a big fan of that at 8:30 p.m. Singapore time because this number is rather volatile because it will be releasing every week instead. So there is we call that there could be what I call cyclical or seasonal impact that could impact this particular we call it data print. Okay, so but it will be out at 8:30 p.m. Singapore time. All right. So in early tomorrow morning, is there any data to take note of? Let me have a quick glance. No. Okay. So in early tomorrow Asia morning, there's no clear key data to take note of. All right. So with that, that sum up today's daily dose of market insights. Kelvin here, signing off. Wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.